ticker symbol HIMS has had an impressive year and is up around 115%. So today we'll be looking at an innovative company which is digitalizing the health industry. This incredible company recently turned profitable, and the thing is that they have solid fundamentals, improving efficiency ratios, and over 35% year-over-year revenue growth. So today we'll be looking at HIMS and Hers, a digital health company. In their annual report, they state that they're a health and wellness platform which is focused on providing modern, personalized health and wellness solutions to consumers. This company has developed a platform or an app which gives you access to a highly qualified provider network, a medical record system, digital prescriptions, and even cloud pharmacy fulfillment. Remember all those companies such as Teladoc, which started digitalizing the way we go to the hospital? Well, this company takes it one step further and even brings all the medication straight to your doorstep, as you can obtain the prescriptions and the pharmacy products online. Additionally, this company has also developed some treatments for a broad range of conditions, both for prescription and non-prescription products. For example, some of the ones that they provide may be related to sexual health, hair loss, dermatology, mental health, and even now weight loss. Now, one really nice thing that this app can do for you is that prescriptions may be fulfilled online through licensed pharmacies, and also some of their products can be found in top retail locations. Additionally, some of these products may be obtained on a subscription basis, and you will automatically get them at your doorstep every 30 or 60 days. Now, they do outline a growth strategy in their annual report, but I decided to break it down into the two main points. First one is that they want to build a brand which is trusted by customers and which is able to normalize the practice of receiving tailored treatment through digital channels and through clinical excellence. They state many times, and they believe that trust is the absolute key driver of purchases in this kind of industry. This is why they're first of all pushing for clinical excellence and getting some of the best doctors and some of the best experience online, and then also being able to customize and personalize the treatments is something that will give customers a lot of trust on this brand. And the second growth strategy is to leverage platform insights to offer access to, again, personalized prescriptions and non-prescription treatments. So the good thing about this app is that the longer you've been there, the more information your digital medical record will have, and the better the personalized recommendations will be for you. And although I'm not an expert on medical companies, I do like seeing the financial analysis. Right now, they have a low return on capital employed of 6%, but this is because they've only been profitable for 2 straight quarters, so their net income is currently very low. Now, they have a very high interest coverage ratio, which basically means that they don't have to worry about any of their debt repayments anytime soon, and they have a solid cash conversion of 83%, meaning that they're pretty efficient with their free cash flows. Now, their profit margin is an 82%, and over here their operating margin is only at 2%, but because inside the calculation for the operating margin, there were also some quarters which had negative income, and this of course hurts the operating margin. I believe that the margin for the last quarter only was closer to a 7%, which is already better. So here we can see the trailing 12-month revenues, gross profit, and net income, and it just looks beautiful. Everything is growing, even the margins are increasing, and as we can see, this company has been profitable for the last 2 quarters, something that is expected to continue moving forward. Now, their efficiency ratios, of course, have shot through the roof, especially that return on invested capital, which is the one that we want to focus on, is already above 20%, which are very solid numbers. And as they move further into profitability, all these ratios are expected to even keep increasing. Now, I love the leverage analysis for this company because they're using the liabilities to increase their growth, but they're also doing it in a respectful manner because their current ratio and their debt to equity ratio are both extremely solid. These give an insight into that the company is actually a safe investment when it relates to their debt position. But now moving on to the fundamental analysis, this company gets a solid 6 out of 8 ticks, starting with the low liability risk that we discussed of their 100 times interest coverage ratio. Then they have a very solid balance sheet, as just by using their short-term assets, they can more than repay their current liabilities. Then this company is of course growing their free cash flow organically, which is something great and something that we love to see in this channel. And the reason why they're having this is because they're also able to grow their revenue organically. Now, organically of course means that they're able to grow without relying on acquisitions. And now the two most important factors in this slide are first of all pricing power, and second of all the existing moat or competitive advantage. In order to discuss this, we have to break the company down into 2 different parts. The first one we can talk about the platform, and the second one we'll have to talk about their development of products. This company is taking advantage of how connected the world currently is and taking one of the main industries which we all have a need for, which is going to the hospital for something relatively minor with the only objective of getting a prescription for something, which is a process that could have been simplified a lot earlier. Now you can do it over text or over a phone call, get the prescription subscription. And the last step is that if you prefer it, you can actually get a subscription and those medications will go to your house every single month or whenever you need them. They have actually managed to develop some very successful and highly demanded products. Additionally, they've shown that they're extremely quick at adapting to consumer trends. As when Novo Nordisk started introducing Ozempic into the US, which is a weight loss drug, HIMS and HERS was very quick to actually research and develop a new GLP-1 drug, which is of course a weight loss product, and they have been able to actually benefit from the growth in these type of medications. Now, why does this give them pricing power? Now, first of all, the products that they offer are situated in a premium category. Most of them have extremely good reviews, they're very recommended by doctors, and most their users that I have seen have actually had a very good experience with the company. When you have happy customers that are actually enjoying your products, first of all, they will come back for more, but second of all, you can allow to charge them a bit more as they will be willing to pay a bit more for your products than for any of the competitors that they don't know. Now, when we move into the platform, I would be willing to pay a lot more for using this app than to go to the hospital, wait in very long queues, and then just have to displace myself to go to a pharmacy and buy it every single month. Whereas over here, I can do the whole administrative task on my phone and then just get the prescription immediately and order it from a pharmacy and even place a subscription for the product. This to me would save a lot of time, which would translate into me willing to pay a lot more money for this service. But now we have two aspects that are not very positive over here. The first one is that their cash flows could be a lot more consistent. And now this I have to admit that I have been a bit picky because their free cash flow is more or less around the same range every single quarter. But some quarters it's growing, some quarters it's actually decreasing, and it's not as predictable as I would like the company to be. But now the other aspect I didn't like is that first of all, they're not paying dividends and they're not buying back shares. But this of course makes sense because all the free cash flow that they're actually generating, they're investing back into the business. This is allowing them to grow at the solid rates that they've been growing so far. So these two aspects are just me being very picky because I believe that this is a very great company. Now, when we look into their valuation, of course, it trades at a very hefty premium. Now, we only have one price to earnings ratio because all the others, the earnings were negative, but we can look at the price to cash flow ratio, which is also trading on the high side. I believe their price to cash flow ratio for the latest quarter was actually around 70 times, which is very high if you compare it to peers in the same industry. Of course, when it was trading at the cheapest, which was quarter 3 2023 or quarter 4 2023, the price to cash flow ratio was closer to around 30 times, and that is still expensive. But this is what you have to pay for a very high growth company. Now, when we look into their free cash flow yield, they're currently yielding a 2.8%, which is lower than the long-term inflation rate of 3%. This, of course, means that the company is not at an attractive valuation, but now some risk and possible challenges that I see is first of all regulation. I put this at a very high 70% because they're in the health industry, which is probably the most regulated industry out of all of them. And there are currently being some discussions on whether to ban or regulate further GLP-1 products, which would of course affect the revenues from HIMS and HERS. And now number two, I actually put them not meeting performance objectives at a 50%. When there is so much hype around the company and they don't meet earnings for one quarter, it causes a disaster. For example, in one of the latest quarters, Nvidia grew by massive amounts, but the market was expected a bit more, so the stock fell around 10% in one day. Now, before we move on, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence, but I do believe that this company has a very strong competitive advantage, or they're in the process of actually strengthening it, but they do not provide consistent cash flows, and I do not believe that they are predictable. Now, the high return on capital employed, I put it a maybe, because although it currently does not have a high return on capital employed, if we only take the net income from the latest quarter and we annualize it, meaning that we multiply it by 4, that would actually give us an acceptable return on capital employed, meaning that it could actually be creating value for the investor very soon. So I do believe that this is a good company and it will probably be a great investment if we can buy it at a better valuation. So thank you so much for watching. As always, this has been the Cashflow Compounder. Join the Patreon for extra content and there is a link in bio for a free stock if you join Trade Republic.